We're going to touch on some of the ways in which buyers and sellers can deal with and bridge valuation gaps through different pricing structures. I'm Liz Donley. I'm a partner at Hogan Lovells in our M&A practice. I'm based in Washington, D.C. I work on all sorts of M&A transactions, buy side, sell side, stock assets. I do a lot of carve-out transactions. My primary focus is working with our U.S. public company clients on their global and cross-border transactions. Brett?
And my name is Shawn. I'm an assistant general counsel at Warburg Pincus. Warburg Pincus is a global private equity firm. We do a whole range of transactions, everything ranging from venture rounds to multi-billion-dollar buyouts. And I focus on transactions anywhere from India, Europe, the U.S., and Brazil.
All right. Good morning, everyone. My name is Michael Wolf. I'm Deputy General Counsel at Baxter International here in the Deerfield area. I'm in charge of, I guess, what they call business development and licensing, but it's basically an M&A job. I've been an M&A lawyer now for, I guess, almost 25 years. I did 8 years at Merrill Lynch before that. Have sort of a quasi-business legal background. Baxter, for those of you that are not aware of it, is a life sciences company, medical devices, pharmaceuticals. And we are a global business. We do deals around the world. I guess that's about it. So.
Great. Okay, well, we're going to start with net working capital adjustments. You can't really talk about pricing and deals without talking about net working capital. So by show of hands, who in the room has dealt with a net working capital adjustment in an M&A deal? Pretty much everybody. It's not surprising. And of those folks, how many of those have led to some form of a dispute, whether it's arbitration or something? So interestingly, disputes around purchase price adjustments and working capital adjustments are almost as common now as warranty claims, reps and warranty claims. They're increasing, I think, in frequency. And when I started practicing 20 plus years ago, the net working capital adjustment was really simple and straightforward. You had a reference balance sheet of a particular date, you closed, you calculated your balance sheet, you did some simple math, and everybody went away happy. But now it seems it's becoming increasingly more complex. The structures are more complicated and therefore more prone for dispute. So for our panel here, interested in views as to sort of reasons for this dynamic and when making a deal, when doing deals, how can we either be prepared for or avoid dispute or sort of deal with this complex dynamic?
Yes, my guess as to why that is that people, everyone knows deal making is, just gotten more and more competitive, particularly, most places it's a seller's market. And so buyers are out there, trying to differentiate themselves. And usually that in an auction, people are looking at headline price. If you have a good banker, they're also going to be looking at, how working capital is defined, those sorts of things, maybe how debt is defined in particular. But headline price is going to be what people are going to focus on the most. And I think that a lot of the sophisticated deal people who are involved in those deals use that as an opportunity to be like, okay, we can pay this much, but we can only do that if we get our definition exactly how we want it. And so it's really important for everyone in the deal to sort of go in eyes wide open that that's the game that's being played, so that you avoid a dispute later on. It's probably you see that theme around earnouts too, and we're talking about earnouts later. But I think it's just competition and sophistication is in some cases leading to things that should have been addressed up front having to be addressed on the back end in a different sort of forum.
And like with many trends in M&A, private equity, tends to lead and sort of shape a lot of this, and was probably the first to sort of take advantage of that dynamic that you described. So, Michael, knowing that these can be so, ripe for dispute, and there's a lot around the edges, and it can really be an opportunity of value trade, whether that's a good thing or a bad thing. How do we think about and we're all lawyers up here, so I guess maybe we're biased, but how do we think about the role of the intersection sort of law and accounting and really getting this right?
Yeah, no, it's a great question, because I do think that when you have problems, it usually comes as a result of a misunderstanding or miscommunication somewhere in the chain. And to Brett's point, there are players out there that view this as a value shift opportunity, and then there are players that are looking at just deliver me a business that I expected to be delivered, right? And at first level, you sort of have to have a common understanding as to what you're trying to do with your working capital adjustment. So let's assume that you're starting out with the theory that we just want to targeted amount of working capital there. It's not about value shift. How do you ensure then that the target and their accounting and finance team and legal team is communicating to us what we need to understand in order to set a target appropriately? And does the target link up with, you know, the way we're going to actually calculate it, either at closing or post-closing? And I think the only way you can get this right is by having a multidisciplinary team doing it. Too often I see, within days of signing, right, somebody lobbing over a 7-line item net working capital calculation, right, with no sub-accounts, no explanation, no footnotes.
Right.
Somebody in finance, and this is not at my current employer, I would say this is more in private practice, looking at it very quickly, saying, yeah, that looks about right, and signing, right? And people wonder why there's a dispute then, right?
Right.
Nobody understood what was on the sheet initially. In fact, the people that prepared it probably didn't even understand what they were doing and how it related to the rest of the deal. So it's really about having a conversation, which I know is hard to do in an auction process where people are pressed for time, but you have to have a detailed conversation. What is in each line item? What is each component? What assumptions go into that? And when you have that alignment of understanding, you tend not to have the disputes. And of course, the drafting has to sync up with all of that. Absolutely. I think the other thing is for the people that are pure finance and accounting professionals here, as you probably are aware, there is also legal definitions usually in a purchase agreement that have to link up with that. And I've seen deals where people define current assets in one way, but the spreadsheet is prepared entirely differently. Right? So it's about getting the right team members into the conversation and making sure there's an alignment of understanding.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A academy, offer M&A masterclasses, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
I think it's also important, and Brett, please weigh in too, but I think it's also important for everyone to be eyes wide open about, well, what is the remedy if it turns out that this company that you're buying does not use GAAP accounting, or because a lot of people like to, after the fact, go back and complain. They buy the business and then they start looking at things and realize, this isn't what I thought it was,
right,
and want to use the working capital adjustment as the opportunity to fix that. Whereas that's really not, an
There's
appropriate.
Case law against you.
There's
for
case
that.
law, exactly. So CB&I Westinghouse would, tell you that you can't do that. But people try, and having to go to an arbitrator is very difficult because we'll get too in the weeds on this. But when you go to an accounting firm as an arbitrator, their job really is to determine the right amount, the right number that goes in each account. And then you sort of blend into the legal side when you have a dispute over, but which accounting rules are the right ones to apply? And I think a lot of ambiguous drafting can lead to real tricky problems there. And I might add too that, now that reps and warranties insurance is pretty much the norm, you've got a no recourse against your seller. And so I think it puts more pressure, frankly, on the purchase price adjustment, because it's one way in which you might be able to, as a buyer, get some value and remedy if you do discover that there's a problem with the financials after the fact.
Yeah, no, I think that's all right. I mean, I think one of the themes that I think goes hand in hand with the sort of no indemnity deal that's becoming more market in a lot of transactions is the purchase price adjustment will also be limited to an escrow. So you got to be super sure that all your definitions are right, because you're, as a buyer, your remedy is going to be limited. And then there's the flip side conversation as a buyer, whether you want to commit to or whether you want to only have a limited remedy against you as well. So a lot of times what we'll see, buyers say, seller, I will allow you to cap your exposure at the escrow, but I want a reciprocal cap as a buyer where I don't have to pay more than an amount equal to the escrow. And sometimes buyers will win that point. Another thing that I'll say that I've seen that's, I think, an interesting way to try and reduce disputes, I'm not sure if it works, but sellers will often say working capital is defined as only the items set forth on the schedule. And as a buyer, that always makes me super nervous because, like, what if there's something we haven't thought of, or like, I don't know exactly, how you account for everything. What if there's something that goes into a different category that under GAAP would be a current asset or a current liability, but you haven't listed it? But I think that's something that sellers use to try and reduce disputes. And I've seen buyers agree to that when they get their accountants like super comfortable that yes, okay, they've listed like everything that could possibly be a current asset or current liability.
Yeah, I don't know what your experiences are, but for me, I feel like more often than not, your disputes come into play around reserves and sort of judgment calls about what goes on or off a balance sheet, or whether or not you remove, whether or not you're removing a reserve, for example. Anything, to me, like I've never really had issues with. Well, I guess that's not so. I've had some issues with revenue because there's a lot of ways you can go at revenue and whether or not it's net or gross. But a lot of times it's about, oh, we pulled that reserve off because that liability wasn't there. Would you ordinarily do that? Is that consistent with your past practice?
Right.
Does the contract provide that it has to be consistent with your past practice?
I think that's absolutely true. And you can have really detailed accounting principles on not being able to change reserves unless there was a change in facts and circumstances, but those often get negotiated out. So then you're relying on historical practice. Yeah, that I completely agree with you. That's usually the area where you see a lot of dispute on that. I guess one other sort of practical one that I've seen recently that maybe helps mitigate the scenario that Brett was describing, where you've only got a limited escrow to go after. So another dynamic that often happens is you've got your target, so that's based on multiple methodologies, percentage of sales. It may just be a made-up number. It may be an actual, average of 12-month balance sheet, whatever it is. So you've got your target, and then you usually have an estimated adjustment at the time of closing. And that's usually delivered very soon, only 2 or 3 days before closing. And then the dynamic that Michael described happens where people say, oh, yeah, that looks about right, and you close. But that could raise or lower your price on the closing date. And so then, we've had one scenario where it was actually, I was on the sell side, it was actually a PE buyer who said, well, we need to cap, we'll do the estimate, but we're not going to pay more than this percentage over the headline price at closing, because they didn't want to be exposed in a large amount and then have to fight to pull it back. And I thought that was a good tool to sort of rein in some of this swing that can happen when you're dealing with an estimate that everyone has 2 days to get comfortable with. So
one other area that I think is maybe appropriate to look at is like compensation items that are in net working capital. Straight payroll is pretty easy, but when you start talking about bonuses and incentive comp and items like that where they aren't necessarily sort of a steady rate and you're accruing them on a regular basis, create the opportunity for problems when there's a disconnect between what HR and the comp people think is going to be paid post-closing and what's actually accrued for beforehand, with the notion that there's some allocation of responsibility for those post-closing payments. So take a mid-year closing, June 30, your sales team has been working for 6 months. There's an accrual on the balance sheet for sales incentive comp. They need to sort of dig in and understand that plan, and they need to understand timing, and they need to understand how that's going to get paid, whether or not it's going to get moved on to the buyer's comp programs, whether or not you're going to continue to pay out under the seller's programs, and make sure that all links up with the accrual. Because I often find that, at least in with the exec comp and the benefits folks, they aren't very close to the working capital calculation. They don't understand what's in it. They just know that they have an obligation to make certain payments post-closing. So I think, again, it's another example of bringing together the right constituents to ensure there's a common understanding of
Absolutely.
what's in
You
and
can
what's out.
definitely have a windfall one way or another
Yeah.
on this.
Yeah.
So why don't we open up to questions? Do we have any questions on this topic before we?
Hi, Christina Angara with JLL. Curious as to what your practice has been in treatment of deferred revenue within the context of working capital.
You must have read my mind, because just thinking like I should mention deferred revenue. So particularly in like a software kind of business, people are always very focused on deferred revenue. I think, one strategy is to include it in indebtedness so that it's always just a deduct and you don't have to worry about, how it's going to impact the target exactly. I would say that's a fairly buyer-friendly approach. Probably more often I see it just included in net working capital, so it goes into a discussion of what the target should be. One thing that usually you look for on the buy side is to make sure that both long-term and short-term deferred revenue are both in working capital, because you can imagine if you agree to provide, you get like a payment up front for like 5 years of service, then that's 5 years deferred revenue. Like as a buyer, you shouldn't be able to, as a seller, you shouldn't be able to game it by entering into like excessively long-term contracts. So it's something that particularly in sort of software services businesses we're very focused on.
And just to follow up on Brett's point, the point about buyers preferring to have it in indebtedness, and just to sort of expand on that, the rationale for that is that you get another bite at the apple as well. So you're not messing around with an adjustment, but you are dealing with it usually at closing, but often you also get an indemnity for indebtedness that's not subject to basket.
If you're lucky.
And
If you're lucky.
indebtedness starts at zero, whereas
Yeah.
I actually had one deal where there was a separate deferred revenue adjustment just on its own, and that was a pretty simple, straightforward transaction. It was a limited net working capital, and there was a target deferred revenue, and it was just handled explicitly. So, anyone else? Okay, why don't we then shift to our next topic? So we're sort of going to the opposite end of the spectrum to talk about lockboxes. And how many folks have actually done a lockbox deal? All right, good. There's fewer because it's
Wait.
not as common.
Can you ask a follow-up question? How many people were invited to participate in a process here in the U.S. in which they suggested using a lockbox, and you threw up all over it?
Yeah. I think that happens a lot, yeah. So the lockbox in many ways is really similar to the net working capital adjustment. It just happens at a different stage in the process. So, folks are probably generally familiar with how this works, but you in essence take a balance sheet as of a particular day. So say, in year end of now 2018, which is actually a long period of time, which is one of the issues. And you sort of negotiate your what they call the equity bridge between that balance sheet. You negotiate your cash, debt, working capital numbers at the time. You negotiate some permitted occurrences called leakage between that date and your closing. But otherwise, it's sort of locked in, and the earnings and the upside and downside of the business is theoretically contained for the benefit of the buyer during that period of time, for the benefit or detriment of the buyer for that period of time. It's a really popular mechanism in Europe. We see it, proposed in European deals very frequently. And it's generally thought of to be a seller-friendly seller-friendly construct. So I guess it's interesting. We're seeing, obviously, and again, largely driven, at least originally by PE, the use of reps and warranties insurance is a great tool to give a seller a clean break. And in many ways, the lockbox mechanic does the same thing in the sense that you don't have this post-closing, what we were just talking about, opportunity to either find or lose value on the sell side. So why do we think, I don't know, from the PE perspective or from the strategic perspective, why do we think the lockbox hasn't caught on in the U.S.? Are we missing out on something here, or are we just not open-minded enough, or?
I was going to generalize a bit. I don't, and it's always dangerous to generalize because I'm sure I'll get shouted down in this room. But I think my experience in the UK has been that it's generally a more seller-friendly market to start with.
Yeah.
So, maybe it's easier to see it catching on in that marketplace as a result. I think, as a U.S. lawyer, there's a lot that I react poorly to, especially when you have deals that have a fairly extended period of time between signing and closing. There's a lot of risk there, I think.
But what if it's a growing business and you have 6 months, then you're basically getting 6 months seller financing.
That's right. Yeah, I mean, it's
And the ticker, even if there's
it
a
may be a
ticker,
bet worth
is
taking.
like, 5%, 8% ticker or something. If the business is growing at, 20, 25%, knock on wood, then it's pretty awesome from a buyer's perspective.
Yeah.
In theory.
In theory, and the seller, of course, would never propose it in that circumstance.
Exactly.
Right?
So there's adverse
Yeah.
selection. Yeah, that's right. I agree with you. I don't have like a great answer as to what, other than, seller-buyer dynamics as to why it hasn't caught on here. I mean, I think that, it front loads a lot of the discussion, and, in deals where there's a long executory period, it can be actually really good for the buyer if it's,
Right.
a business that's growing. So, I mean, but on the flip side, if there is a lockbox and there's not a long executory period, the seller is going to expect it to be priced accordingly. So
Yeah.
you're not really, it's not usually going to be a windfall for the buyer in those circumstances.
Mm-hmm.
I wonder if, and maybe the people that have done them in the U.S. in this room were in this set of facts, but I think if you had a competitive enough process, I mean, if you think about it, like RWI was something that started on the fringes, it's worked its way into a few firms as it relates to private equity, but now it's finding its way into sort of all strategic deals. And, in a very competitive process with all strategics, you can still, you can demand it. In a less competitive process, you're not going to get it. You wonder, I wonder whether or not the people that have done it in the U.S., it's been in highly competitive processes where the seller could demand it.
It's very possible. Some think that here in the U.S. we just can't help ourselves. We just have to get in there and have, something to mess with. I did a deal recently that was a U.S. buyer and a European, it was a German seller, and we had a lockbox. And we had to live with it. It was a competitive auction. We had to do it. But we just couldn't take it just could not help ourselves, So we actually wound up with a situation. We were negotiating, this may be, a unique situation, but we were negotiating around October, and we were planning to sign probably November, December. But the audited financials that we were relying on were from the prior year, so they were almost a year old. And the length of time between the financials and your ultimate closing date creates more risk. So we came up with we called it the hybrid, where we did a lockbox, but we agreed that we were locking the box on December 31st, 2018, which had not yet occurred when we signed. So we had essentially, we're actually still in the middle of it now, so whether this was a good idea or a bad idea, but we had an agreement that we would agree on the balance sheet after the fact and apply that. So the equity bridge stays. We agreed on the principles, of permitted leakage and all of that, but sort of found a middle ground because to mitigate that really long period of time, which is one of the downsides for using the lockbox.
Presumably, those are they'll be audited, right?
Yes.
Which is how you take comfort in the fact that it.
Absolutely,
You're not going to review them ahead of time.
Right.
Yeah.
And did you have
So-
did you have the ability to object?
We do, and now
Okay.
that's happening right now. So we'll see how it plays out. I'll
It was
keep you
basically
posted.
it was a future lockbox.
It's a
Yeah,
future
future
lockbox,
lockbox, yeah.
It's the same
Yeah, we
lockbox
can-
principles, but you're sort of doing it into the future.
Yeah.
So I think, that wound up being kind of a middle ground. But I don't know, I think the more we move toward, they're very different concepts, remedies for breaches of reps and warranties, and the lockbox, which is, about the balance sheet. But the more reps and warranties becomes the norm, and you really don't have coverage for interim breaches, so in some ways, you're buying the business to some extent. I don't know if we'll maybe start to see people thinking about whether the lockbox is a good tool. And I guess we should, before we all run out of here and think, we should use, we're not really promoting it, but it's, one of the downsides, I think, is it's really only fits in particular scenarios, where you've got a wholly share deal, everything's in the business. Trying to squeeze a lockbox into a carve-out transaction,
Is a
for example,
disaster.
where you have daily cash sweeps and corporate allocations. I think, I mean, not that it would be impossible, but it would be really, really complicated and probably defeat the entire purpose.
Yeah.
So it's kind of your special situation where you've got, a full company, audited financials, not sort of just management accounts of a subsidiary, right? Would make much more difficult.
What do people
Input-
think of the lockbox?
As a seller, it sounds fantastic. I'm surprised U.S. sellers haven't pursued that. It seems like though there's an inherent risk, and I don't see it. I don't see how that would catch on just knowing kind of the U.S. culture. And I wasn't aware. Do you see this more in Asia, Europe? What's the preponderance of using lockboxes? So in Europe, is it like 10% of the sellers use that, or just trying to get an idea of how popular that actually is?
I'd say most deals you
Most
see in
deals,
Europe
yeah.
at least start with a lockbox. Now, sometimes it gets negotiated, and if it's a U.S. buyer, they just, can't get their arms around it, and so it flips. But I think almost every deal I can think of at least started off with a lockbox, if not ended there.
I agree. I haven't seen data on it, but I have to believe it's a very high percentage of deals that end up with a lockbox
Yeah, I
mechanism
would.
in Europe.
Yeah, I would say like 90% plus.
And what about Asia Pacific? Do you see it there?
It's a
And
good
I don't
question.
know.
I'm not sure.
Yeah,
I don't
I
know either.
haven't seen, I really have not seen it, but, so no. At
Thank
least
you.
my experience. I don't know if others in the room may have more. Yeah.
Hi, this is Abik from IDEX Corporation. So I've seen it more often in Europe and more often in private equity deals. And what's interesting is we've seen it a few times in Europe. Private equity funds actually charge you an interest based on the lockbox, between the lockbox date and the close date. And that's, I've seen requests of up to 7% interest in an environment where they can't get interest anywhere else. So it's sort of a tool that's definitely used by PE often, and even in the U.S. I've seen PE use it, but in Europe it's everywhere.
Yeah. The other mechanism you see aside from straight interest is some sort of proxy for profitability, but sort of a defined metric that will tick by the day. So.
And for what it's worth, the deal I was talking with the U.S. buyer, they absolutely know on the interest rate, which I feel like, that's because in a lot of ways it protects, the seller isn't exposed to any downside. It's all the buyer, so that was just something that from the U.S. mindset just could not get our arms around. Why are we taking all the risk and yet, giving you the percentage, the interest rate for that interim period. So
But if the business is growing,
it's
the
a
business
tough,
is growing at faster than the interest
Right.
rate, then it's like a pretty good deal.
right.
Yeah.
Okay, so why don't we move to our next topic? We wanted to talk a little bit about earnouts. And again, who all in the room has some experience with earnouts? Are these something people are seeing a lot of? Yeah, that's a lot of hands. Earnouts continue to be very popular despite their challenges, and I think that's because it's a really perfect solution where you have very much of a difference in value between a buyer and a seller, typically because you have a speculative asset in the middle. Life sciences is an area where we see lots of earnouts where you have, maybe a new drug that has not yet gotten FDA approval. It's a good example. Another, I think key scenario is where you have a business that's being acquired from founders who are really critically important to the success, and you want to keep them motivated and engaged and have them invested in growing the business. And so you put some of the consideration for their sale is, hinged on the success of the business. And I think the sort of classic challenges, obviously, with doing an earnout is, first of all, defining how it's going to work. So in the scenario where, you've got Baxter, for example, buying, a product or a new technology from a tiny company, how does that seller, and their earnout is going to be dependent on the success of that product. How does that seller have any confidence that Baxter's going to put their good salespeople on it and they're going to, give it all the resources and try to sell it, or will they just park it in the, the back corner and then the seller will never see their money? So you find the covenants around, earnouts very heavily negotiated. And then I think you see a lot of disputes. We didn't do the show of hands again on disputes, but I would imagine many of these resulted in at least some if not going to court, some sort of threatening letters and maybe settling somewhere in the middle of these. So I'm going to share your views on the pros and
Yeah, I mean, I think earnouts are, it's very easy for people to agree to an earnout in the heat of a deal because, there's a value gap and, you want to get the deal done, but they are, at least in my experience, like ripe for disputes. And I think the most common thing that people will focus on in sort of the legal drafting stage is the seller will ask for, some sort of covenant that the buyer is going to use, commercially reasonable efforts or some standard to make sure that the earnout is achieved and not do things that are unnatural to manipulate the achievement of the earnout. And the buyer will be worried about being constrained by those things, particularly if it's being integrated into a larger business and you have to deal with customers and maybe they don't want the new product as much as you think they're going to want the new product. And you want to be able to offer them an existing product that's not triggering the earnout. So that's like a very upfront thing that everyone rightly focuses on. The thing that I think people may not always focus on as much as they should is if you're doing a bolt-on and it's the founder situation, the founder's going to run the division, you need operationally to make sure you're watching that founder. Because we've had situations in one of our portfolio companies where the founder, so there was an earnout based on revenue, and revenue was basically defined, you recognize the revenue when the contract went live. So how do you define go live? The way it was defined in the contract was go live is when they they pay the first bill. And so what the founder did is he called people up, be like, can you please pay now? And it was before the thing was actually going live the way like most people would think about it. So it was manipulating when how it was operating in order to achieve the earnout. And that's not something that the contract is sort of going to protect you against. I mean, it could, but it's more of an operational thing. Like, make sure you're watching them; they don't, do something unnatural.
So, did you pay him, or did you get in a dispute?
We're fighting
with,
about
you're
it.
fighting about it.
So we use milestones, earnouts, contingent forms of consideration all the time, and I think as Liz pointed out, it is more common in the life sciences space. I would say when I was in private practice, I would counsel clients to avoid any form of contingent consideration at all costs. And in particular, I think it's a terrible way to sort of deal with sort of generalized different views about the trajectory of the business. It's a much better tool for things that are a little more binary. So, you either get a product approval or you don't.
Right.
You either launch in this jurisdiction or you don't. It's generally easier, although not easy, but easier to draft triggers around that. Now, to Brett's point, one would think, when does the contract go live, that's something that you could probably draft, in a reasonable fashion without too much effort and without casting aspersions at the lawyers involved in drafting that. But look, I've been in practice long enough to know that in the heat of the moment, lots of things get written down that in hindsight you probably wouldn't write it the same way. I think that the key is to have an easy trigger to draft. Now, the other thing I would say about milestone payments or earnouts is, I see a lot of revenue-based ones, which are very simple. They obviously are open to their own sets of gamesmanship. But I also think that sort of profitability type earnouts are really easy to manipulate and also very difficult to draft. And so, when we use them, we tend to have much more objective standards in terms of, how you're getting paid and on what basis. This is kind of an interesting piece for me, so I sort of had to dig in a little bit and try and understand kind of what your duty was in the absence of any contractual language. Brent highlighted this idea that we often negotiate a series of affirmative covenants and then probably some carve-outs, things that we absolutely don't have to do in order to sort of put guidelines around the buyer's behavior once they own the asset. And this was interesting to me. So in Delaware, I think it's still a current law, that if the contract is silent, the only obligation you have is really your implied faith of good faith dealing. Yeah, and it essentially means that you can't take any action with the intent of undermining the seller's ability to earn the milestone payment. But I was surprised that there are a number of jurisdictions in the U.S. where there is actually an affirmative obligation under state law to use some form of commercially reasonable efforts to achieve a milestone or earnout payment, and I think California is one of the jurisdictions. I'll just say that. But go do your own research or have your lawyers do the research. But I believe it's in California. But that's something to pay attention to, because even though you may think you're successful in terms of, in the case of a seller or a buyer, negotiating essentially a very bare bones set of obligations, you may be signing up for more of that under the applicable law of the contract.
Yeah.
That's a good point. I think it's a good example where, at least on the lawyer side, we sometimes, a business person can get really excited. Oh, this is a perfect solution. It's almost like, let's do a joint venture. It seems
Let's
like
do a joint venture. One of my favorite words of all time.
let's do a joint venture. Those are so friendly, but but it sounds like the perfect, easy solution. Oh my gosh, we've been at a standoff and throw it into an earnout, and then we sometimes have to be the bad guys who come in and say, here's the 52 things you need to think about. Here are all the questions I need in order to be able to draft your earnout. But it really is an area where people need to be careful. So, any comments or questions, experiences on earnouts? We've got one.
Thank you. Good morning. Brad West, PGT Innovations, manufacturer in Florida. My questions around earnouts are the consideration where you're dealing with a family-owned business. This is a buyer, obviously buy side I'm talking about. And the earnout is not so much about a certain achievement of a goal as it is you need that talent for 3 to 4 years. And you really need them to be involved, because without that, you're not going to have a successful integration. So, I'm trying to think about what the right way to think about an earn on that set is. And then also, when you're dealing with in a bid process, where you're strategic and some of the other bidders might be sponsors, and how you are thinking about that earnout in that context in the bid process, and how the seller may perceive it.
I'll make one comment and then you guys chime in too. But on the talent retention, I think one thing to think about there is whether this is really an earnout or whether you want to offer employment, related incentives. And, you can structure that in different ways, we have to really get into employment law too, depending on what state you're in, as to whether you're, this is a nice employment package, you can incentivize someone. You always have a difficulty when you have a founder who's very valuable but who's going to receive a lot of money in the deal, right? Because you can't make the person stick around. So I think earnout as a choice, you can think about, sort of a non-compete related payments, other ways to structure that. But that's definitely a tricky dynamic, because it also, I guess exposes you. You do have some exposure, obviously, right? Because the person may not stick around. I think that as a strategic, you have to think about, is this business valuable to us, in that scenario. But I think that starts to drift into some legal complexities too, as to whether it would be actually deemed an earnout. But what do you guys?
Yeah, I would say if you're looking to retain someone for like 4 or 5 years, I would say usually you wouldn't do that with an earnout. And at least in the private equity context, the typical way to handle something like that is with a rollover. So you say, I'm only going to let you take out, 50% of your proceeds, and you have to reinvest the other 50% in the business. So that creates some natural alignment. And there's another structure I've seen where you basically say, I'm going to hold back your proceeds until you actually have worked here for a certain number of years, and that can create some tax complications depending on how you structure it. It might result in a recharacterization of capital gains into income, although there are ways to, depending on which tax person you talk to, they can be more or less aggressive on that point. But I'd say an earnout is like a potentially dicey way of dealing with it.
As a strategic, we rarely go into those circumstances with the idea that a rollover works.
Strategics don't like rollovers.
We don't like rollovers. I think, you sort of, there's no doubt that some milestone structures or some earnout structures have a retention capability, but I think philosophically, and maybe this is to Liz's point, you sort of need to decide what you're doing with each program. We tend to go in with sort of specifically tailored retention packages for people that we want to keep around for a certain period of time, or that we want them to accomplish certain tasks. And it may well be that they're also entitled to an earnout, which we will acknowledge as sort of having additional retentive capability. But our goal usually is, retention and value, gap closing. We tend to keep them separate in terms of how we think about them going in, even though they may have some of the same effects.
Yeah, I've done a lot of sort of strategic company acquisitions of family-owned businesses, and I guess part of the, a lot of times the founders really want to stay around. They want to see it through, so I think some of that is also really understanding the motivation to sell and what they sort of, see as the legacy of the business. So, a lot of that but you should definitely talk to the lawyers about not sort of circumventing or dealing with potential tax and employment consequences, I would say. Other earnout related thoughts? Okay. So we thought our final piece here, any discussion on consideration would not be complete without at least touching on issuing stock as consideration. The most sort of obvious example being in a public company context where, the consideration is being paid in stock, either with a floating or fixed exchange ratio or a mix of cash and stock. But even, in the private company context, there can be a way to sort of align the interests of the buyer and the seller if the seller is receiving, it's even in the rollover context,
rollover,
that you have a portion. And so that can definitely be, an important tool. And maybe we can talk a little bit about in the rollover setting, because that really motivates your seller. The seller is directly, literally invested in the success of the enterprise. And you can do this in private equity. It's a real struggle in strategics, because a strategic, they want to own 100% and start integrating and everything that goes with that. You do see strategics making venture investments, and taking minority ownership in companies. But when a strategic identifies a smaller company with a technology they want, or a customer base they want, or a manufacturing plant, or whatever it may be, the rollover concept is really tough. But maybe we can talk a little bit about sort of the benefits of issuing equity, or equity rollovers in the PE as one example of stock consideration.
Yeah, from the PE context, it has a couple of, big benefits. One, it reduces the check you have to write, so you don't have to call on your LPs to, put in more money. Two, it creates alignment and, some, natural alignment between you and the seller, because one of the things you are worried most about is, a founder gets $50 million and they just want to go, sit on the beach.
Right,
so it's better if, they only take $20 million and then, there's $30 million that could turn into $100 million if they just, stick around and, do a good job. So I think that's sort of the two of the key motivators for, pushing for, some significant equity role in most private equity transactions.
And I think from the strategic perspective, as we sort of suggested before, when we think about equity going to our employees or the former founder or whoever it may be, we generally issue equity for broader purposes, right? We want our employees to achieve broader goals than just be successful in the portfolio company that the private equity company acquires, right? We want them to go out and sell other products and figure out other ways that their technology can be used across the organization, whatever it may be. But the idea is you're being incented on sort of the corporate success as opposed to your old company's success, and that's where we sort of go come back to that whole distinction between retention and value value gap closure. We have programs that are designed to retain. We have programs that are designed to incent, and that's generally broader corporate behavior. And then we have programs that are designed to close the gap in value, and we tend to think of them not rigidly, but we tend to start with 3 buckets. They may collapse over time, but
yeah, and I think that's helpful, Michael, to think about what is really the objective, right? So when you think about issuing equity as consideration in an M&A deal, what is sort of the underlying reason for doing that? And it could be financing. It could be you're in a situation where, the company doesn't want to borrow cash, and it just makes more sense in sort of the financial modeling to issue shares or issue, a combination of shares. in cash. It can be for tax reasons, so I did a deal recently where this was also a family-owned business, but it was a long, I don't know, 60, 70 years or something, and they had lots of employees, so it was a huge, and a huge shareholder base. They'd issued shares to people over the years. And they wanted to have a tax deferral. So basically, if you structure we had to pay at least, because it was a forward merger, we had to pay at least 40% of the consideration in stock. So there was a tax benefit to the sellers to doing and this was actually it was almost like a law school exam. It was an interesting one because we were a public company, but we were issuing in a private placement, but there were about 200 people, not all of whom were accredited investors. So we did a split of cash and stock, and we had to design our merger mechanics to essentially force people who were not accredited. Actually, you can include up to 35 non-accredited, but we had to, for people who were not the top 35 non-accredited, they were forced to take cash. We also had not a large number, but a fair number of international investors, and so to just avoid all of the complexities of dealing with securities laws outside of the United States, if you were not in the U.S., you also took cash. So we were able to take kind of a lot of liberties. It was a very complicated merger mechanic, but I think it's interesting to think about, and that was a relatively small deal compared to our issuer. But another, issue could be if you wind up issuing so much stock that you cross the 20% threshold, you may need a vote of your shareholders, which you want. So there's lots of dynamics, particularly when you're dealing with a public company issue. You have to do this through a registered, offering or through a private placement, and sort of navigate all those waters. But that was a really interesting one. It can be done. It just takes a lot of, making sure you're thinking through all the different legal regimes that you're implicating in doing that.
Yeah. Another dynamic I find that's interesting is if you issue so much stock that the target is going to become a significant shareholder in you, then it sort of switches. They kind of view it as like they're a buyer as well. And then your purchase agreement, which had them giving you a bunch of reps and you giving like 4 reps, all of a sudden they ask for reciprocal reps. And then what's super
diligence.
Yes, and diligence, exactly. And what's also really interesting is if there, and then the closing conditions start to align as well. And then a question is if there's a MAC on the buyer side,
Right.
the seller walks away, or the seller walks away. They don't want your stock. They don't want your stock anymore. And then, what are the remedies that survive termination? That's another thing that sort of we've thought about in that situation on the buy side offering stock, because you don't want, one thing that at least from a private equity perspective, you want to limit your remedies, limit remedies against you, except in certain specific circumstances. So if your company is if you're the buyer, you're offering a bunch of stock, seller has a walk right because there's a MAC, you don't want the seller kicking you when you're down and making a damages claim against you because the deal didn't close. So that's a sort of nuance that I think people should focus on if they're on the buy side offering stock.
I think is sort of a related point is in a private context is self-funding your own indemnity claims. Ensuring that you're not actually fronting part of the indemnity claim because you're both stockholders, right?
Yeah. No, exactly. And one way we've dealt with that is in the shareholder agreement, you'll say if an indemnity claim comes in, it's sort of allocated to the shareholders of one side or the other, and that gets super complicated, and you have to talk to your insurer and your broker about that, because if their role is over 30%, then the payment of the loss will be prorated because they don't want to insure the seller against something they knew about. So then you just have to make sure those proceeds are rooted in the right direction.
That's a hot mess, as we say.
Yeah.
Absolutely. Okay, we have just a couple minutes left. Can we take some questions? Yeah. I have a couple.
Hi, this is Abik again from IDEX. Just a perspective I wanted to share. So before IDEX, there was a company called Hillrom, and so we were a $2 billion market cap business, and we acquired a $2 billion private company. And so stock consideration actually helped us in a big way to solve 3 problems. 1, we didn't want to raise too much debt because we were worried about credit rating. 2, there was a value gap between us and the family of where they thought the company had to trade. And then 3, there were some social issues that this business had actually built this town of Skaneateles Falls, New York, and they wanted to leave a legacy saying, we're still invested in the business. So we ended up, the Welch Allen family ended up acquiring 13% of Hillrom's public stock that allowed us to do the deal. We didn't have to take on as much leverage, so we were below sort of the 3 times or 3.5 times that we needed for our credit rating. And the family got sort of to talk about to the town that, they were still very much invested in this business. And I think, so that was a fairly unique way of it coming together, but those were the 3 reasons that we did that. And it sort of worked out really well, and the family actually held the stock for about a year, and they got some upside out of it as well.
Yeah, I think you do see that feature where sellers want to stay. I think we had another one up here. Sellers want to stay involved, and I've seen some circumstances where they may have acquired, they may have done a deal where they paid more for something, and then they want to sell it, but not necessarily it'd be so clear they're selling it for less, So it gives a way to kind of retain an ownership, like a restructuring as opposed to, so.
Hi, Jeremy Siegel with LogMeIn. We've had an interesting debate on the retention piece, issuing RSUs versus having retention bonuses. Historically, previous companies we've done more on the RSU side. My current company would do more on the retention bonus. So I'm just curious to get your perspective on pros and cons to each, and where you sort of lean.
It's a good point. On the strategic side, that is sort of the proxy for issuing equity, right? Is giving incentives, and I don't know how Baxter onboards executives of acquired businesses and sort of opportunity to participate in those management incentive plans.
So I can't speak for Baxter per se. I think that what I've seen in my experience is a combination where that flexibility exists. So, for large companies with publicly traded stock, I see a combination of restricted stock, sometimes options and cash, all used as part of our retention program. I tend not to see, a choice between one or the other. I tend to see a suite of things, and it's sort of for the recipient, it satisfies slightly different desires as well. Each has maybe a slightly different tax treatment, and also, they may want cash and for part of it, but they may also want to participate in upside going forward for another part of it. So what I've seen is sort of a suite, not one or the other, and I couldn't tell you, whether or not there's an internal bias towards one or the other. I don't know if you do.
Yeah, I think it's hard to generalize. A lot of smaller, fast-growing companies, they're paying people mostly in options. So and that's because they don't have cash to throw around,
right?
And you want to limit your cash burn. Larger companies, obviously, as a equity holder perspective, you want to limit dilution. Right. So that's a motivation to just give someone a cash bonus and hope that makes them happy enough. So I think it depends on the situation the company is in.